You have officially took your first steps into learning how to make money in the stock market. This is going to be a full-on tutorial from start to finish, step by step, using Robinhood Legend, which is the Robinhood trading platform. Simple, easy to understand setup here in 2025, how to invest and trade more specifically in the stock market, how to read the bars, how to read the candlesticks, how to read the graphs and charts, how to read all these little fundamentals that seem complicated, but they're really not. So no more time wasted. This is going to be a long video, so sit back, relax, and let's start it off with showing you guys what we're working with here, which is Robinhood Legend. Now, this is going to be a completely uncut video. If you guys are new here, hit that subscribe button, like the video. Let's jump into it. So, Robinhood Legend is a simple, free-to-use trading platform. Free to use, all right? Simple to understand. So, you're taking a look at Robinhood Legend. This is the main page. Over here on the left-hand side, you can see there are ticker symbols. Ticker symbols are stocks. Stocks have a 3 to 4 letter symbol that shows what the stock is basically labeled under. So for Apple, Apple's ticker symbol is AAPL. Amazon's ticker symbol is AMZN. Most of them make sense. Microsoft, MicroStrategy, Nvidia. So they go through a lot of these names and they all have ticker symbols. Now, ticker symbols are basically just stocks. So if I refer to a stock as a ticker symbol, you'll understand. So we're looking at the stock of Apple. Ticker symbol is AAPL. This is the stock chart of Apple. Looks like a lot's going on right now. There's a lot of green, there's a lot of red, there's a lot of numbers up here, but what's actually happening here is you're looking at what we like to call the 1 day, 1 minute time frame of Apple. So the stock market opens at 9:30 a.m. Eastern Standard Time and closes at 4 p.m. Eastern Standard Time. So between those time frames, that's when the stock is actually trading. There is after hours trading, but we're not going to get into that. So during those times of trading, the stock market opens at 9:30 and volume rushes in. And you can see volume with this bottom portion right here. This is our volume chart, and I always like to see volume because volume is the amount of buyers and sellers that are in the market. So you can see a massive spike in volume here, and the volume is relatively higher in the morning hours and then decreases and becomes smaller in the after hours and into the afternoon. So looking at the stock chart, you can see there's candlesticks. Now, candlesticks are really important because it tells you which way the stock is going to move, how much the stock is currently worth. So it's important to read a candlestick. And I found actually a pretty good diagram here. I'm going to just literally pull this over for you guys to show you what it looks like. So on the left-hand side, you can see a green candlestick. Now, a green candlestick is a stock that opened and then closed higher than where it opened at. So on the 1 day, 1 minute time frame, looking at a green candlestick, you can see the open portion on a green candlestick is the bottom and the close is on the top. Because it's a green candlestick, it closed higher. Now, with that being said, the exact opposite is a red candlestick, because a red candlestick means it closed lower. It starts up top but closes at the bottom. Now, that's the centerpiece here. That's the actual candlestick. The wicks, what they like to call it, the wick of the candlestick is the little bar on the top and the bottom of the actual candlestick itself. Now, the wick means that it traded within this section sometime during that 1 minute period. So this is a 1 minute candlestick. We'll pretend it traded between the highest point it got up to was right here and the lowest point was right here, but it ended up closing right here. So it opened here, traded in this whole entire area, and then closed right here. Same thing, but the opposite with open and close. Red candlestick opens up top, trades in this area, and then closes right here. So with that being said, you now know how to understand kind of what a candlestick looks like. So with this green candlestick right here, which is our first candlestick of the day, I'll zoom in even a little bit more for you guys so you can really see. This green candlestick was our first candlestick at 9:30 a.m. this morning when the market opened. And this green candlestick started down here at a price of, look over to the right, this right column shows us the actual price of the stock, or the candlesticks rather. And the stock opened at $224.78, around that. So $224.78. Traded all the way up to $225.62, but didn't finish until closing here at $225.08. See how I saw that? Open, traded between the wick, closed up top here at $225.08. Now, the next candlestick, because it's a red candlestick, opened at the top but closed at the bottom. So this one opened at $225.09 but then closed at $224.99. But you can see there's a large top wick and a large bottom wick. This never had a bottom wick. This had more buying pressure, pushing it higher, and it closed green. This had some buying pressure at one point, but had more downward pressure, sellers, which caused it to turn red. So right there, you can see that candlesticks green, red, red, green. You can tell which way the stock is going to move based on the wicks of the candle, based on how they open, how they close, and what color they end up being. You can obviously change the color, but everyone just uses, for the most part, red and green. So with that being said, you kind of have an understanding of candlesticks, and you understand that red candlesticks are sellers, green candlesticks are buyers. With that being said, you also know how to read the candlesticks now. But there's still a couple more things before we really talk about and jump into a trade in the stock market, because you got to back up and say, all right, now you kind of know what the candlesticks look like. You know what ticker symbols are. You know what the volume, which is, remember the buyers and sellers, how much, the higher the volume, the more buyers and sellers there are. You know all that, but there's different types of trading and investing. So there are your day traders, you probably heard that term, or your long-term investors. Your day traders are somebody that's trying to make a quick buck, and your long-term investors are in it for the long haul. They're looking years in advance, where your day traders are sometimes trading within seconds, minutes, hours, maybe days. And then if you split those two up, you have your long-term investors are pretty much just looking at stocks, ETFs, and mutual funds, which we'll go into that in a different video. This is specifically more trading side of things. And your traders, you have three types of traders. You have your day trader, you have your swing trader, and you have your long-term trader, I like to call it. Your long-term trader, which is the obviously longer version of holding an investment, is someone who trades a stock for the long term, or looking at 3 to 6 months, 6 months plus for a trade. Looking very long-term time frame, are not in a rush, but still have an opportunity for a trade that they're looking at in the future. 3 to 6 months, 6 months plus is like what I like to call it. Your swing trade, which is that middle portion, can be anywhere from a couple days to a few weeks to up to about 3 months. And then after 3 months, I would call that pretty much a long-term trade. But a swing trader is the same thing. They're trying to make a quick buck, but a little bit quicker than the long-term investor, but not as quick as the day trader. Because the day trader is somebody who makes a quick buck within seconds or minutes, or maybe a day or two. If you become more of an intraday, if you're trading over 1 day, I would call that more of a swing trader. And that's somebody that is in and out, trading with a lot of shares potentially, and taking a lot of risk, but to potentially getting a lot of reward. And that's the whole entire thing. Excuse me, is the entire stock market and trading side of things is all about risk to reward. And you'll see that later when we start going through and demonstrating the difference between risk to reward and how we know it's a good stock to trade off of. Because we're going to look at a trade and we're going to say, all right, we wanted to enter here. How much risk do we have? How much money can we lose? But how much money can we gain? And that's all you're doing. You're just trying to leverage your bet, basically. You're trying to make your odds the highest. Same thing like when you're playing poker or any type of card game. Your odds are, you really only have so much control. And when you do have control in certain areas, you want to take advantage of that. So in trading, you have control of certain areas, but you don't have total control, and that's why it's never, never guaranteed. So just keep that in mind. Now, we're looking at the stock of Apple, and you can click around different ticker symbols, and you can kind of just view different stocks and how they look and everything like that. Going back to the trading element, we're going to kind of map out a trade for you guys, all right? So we're going to go to a stock that I saw the other day. It's ticker symbol NVNI. This was a cheaper name. More specifically, we're talking $2, $3, $4 name with a lot of opportunities for trades and a lot of volume as well. So with that being said, looking at this, we're going to take it as a day trade. So this means you're in and out within a couple minutes, maybe a couple hours. Taking a look at this, we're going to look at the candlesticks here and say, all right, when you're taking a trade, you want to look for a lot of volume and green candlesticks that are moving to the upside above what we like to call this red line here. And you might have noticed earlier, this is our simple moving average line. And a simple moving average line is basically an average of all these candlesticks put together, and it's creating this almost like a pattern or trail that allows us to trade off of it. All right. And what I like to do is enable this simple moving average line, which is really, really simple. You go up here. Oops, you go over here and it's under indicators, and you can add this to any different platform. I use a simple moving average line, which is SMA 9. 9 is basically the length. The lower the number, the tighter this line is to the candlesticks. If we changed this right now to 20, 30, 40, or 50, it would be much wider. But you'll realize that you want the shorter time frame that you're trading, you want a smaller simple moving average line. So we're trading right now in the 1 day, 1 minute. We're looking at this stock NVNI, all right, between the time of 11:50 a.m. and just past noon, around 12:15. So we're looking at a 30-minute period. We want the 1 day, so we're seeing the whole day, technically, if we zoom out. And then each candlestick represents 1 minute. Now, with this simple moving average line, it being a 9, represents that it's very, very tight to the candlesticks, but it allows us to make fine, very, very fine and solid trades off of it. So when we have this red line, which is a simple moving average line, enabled, it allows us to say, all right, when the green candlestick, the first green candlestick that we see, opens above the red SMA line, which in this scenario is this green candlestick right here, that is our signal to buy. Now, it's only one signal. When you're trading, you want to find as many signals as you can, but the problem is you can't have every signal line up. You can't have strong volume. You can't have a hot RSI. You can't have the green candlestick above the red SMA line. You can't be in an overall uptrend on the 180-day chart. You can't have all these. You can. It's very, very rare. But you can't always find those setups in the nick of time. So because of that, you got to take what you can get and leverage what you have control of. That all goes back to the opportunities that you have and how you can, what opportunities you can do or basically take control of. So because of that, we're taking a look at this green candlestick right here that opened above this red SMA line. So at 11:51, we enter into a trade because it is the first green candlestick that closed above this red SMA line here. So now that we had a candle open and close, finished green above this red SMA line, we take a trade. Let's say we entered in at, we'll round it to 390. It's about the center of the candle, I would say. 390, so $3.90, and we're trading with 100 shares. So $390. Every dollar is $100. So that means that every penny is $1. It's easy to play it off that way. So 390. And then the next candlestick happens. Now, this candlestick, not much happened. We opened and closed just about the same price as 398 area. Not much happened with that. The next candlestick, another green candle. We kind of traded sideways, but we closed a little bit higher, up to 411. So right now, those 100 shares are up from $3.90 to now $4.10 off of just 1, 2, 3 minutes. So that's $20 right there. If you're trading off of 100 shares at a price of $3.90 buy-in, and right now we're at $4.10. All right, on this third candlestick. Now, one thing you do want to take into consideration is remember the volume down here. Highest volume is right here. The next candle, a little bit lower volume, and then our fourth candle we see is a red candle with lowest volume. But then we see a surge on the next candle, and this is where we see the surge in the stock price. Now, you're probably wondering, well, when do I sell this thing? Because I saw a red candle, like, does that mean we have to get out? No. You don't sell anytime you see a red candle, because if you did, you would sell out immediately. You want to sell when the red candlestick closes below this red SMA line. So like we saw the green candlestick close above, you want to watch the first red candlestick close below. Now, once we see that first red candlestick below, that's one indicator that you want to get out of a trade. It's not the be-all, end-all, but it definitely could be a signal saying, hey, this stock is losing its momentum. This stock is pulling back from its simple moving average line and is trading now below it, which means that we're in a downtrend. That's something to consider. Not saying it can't go back above it, but it's really a big factor in saying, whoa, we want to pump the brakes in this one, sell some shares, and get out of the opportunity. So remember, we jumped in at 390 here at this candlestick. 1, 2, 3. Now this fourth candlestick is massive. Or fifth candlestick is massive. We had a bounce here where we opened at $4.01 and closed up here at $4.48. Massive move to the upside. We're still in this trade because we're still above this red SMA line. All right. Now the next candlestick was a red candlestick basically flushing to the downside back to 420, and we keep trading. We see this candlestick. Now during this candlestick, it technically went underneath and traded below this red SMA line. For a hot second, it traded below. Now the stock market's not perfect. It's going to trade below, but it never closed below. It still closed above, so we're still good. Traded above, traded above, traded above, traded above, traded above. Now, we're having very, very strong volume as well. You can see the increase in volume, and we don't have a lot of our other technicals like RSI and whatever else that we want to add on. But if we did, we could see that the relative strength index, RSI, would also be pretty hot right now. We're trading above. We're looking really, really strong up here. This is a massive candlestick. We're almost $100 up within about 15 minutes on this candlestick, and we haven't sold anything. Now, you got to remember how much risk you had at the beginning versus how much reward. Because if you're trading off of this red SMA line and strictly off the red SMA line, you want to say, look, you entered into the trade at 390. You have about 15, what is that, 390 to 375. You got about $15 of downside to below this red SMA line. And also, you can look at support and resistance, which we haven't even gotten into yet, but that's also something to consider as well. So we took the trade, and now we're all the way up at $5.80. We have another green candlestick and then a massive red candlestick to the downside, and then we flush again to the downside, trading below. Now, within just 3 candlesticks, we went from being up $100 just about, 90, 95 bucks, to now only being up about 60, 50. So now we're like, whoa, what's happening with the stock? Why did we just lose so much money so rapidly? Like, the stock's going down. I want to get out. You would think that. And you can take profits. You don't have to wait for that first red candle. So you can take half the shares off and you can be left with the rest of the 50 shares to ride. And that way you at least secured easy profits. So if you want to take some shares off, that'd be a fine idea. And also, you saw a decrease in volume. And on top of that, your candlesticks are getting smaller. The larger the candlesticks, whether they're green or red, mean they're higher in volume and there's more buyers or sellers. You got smaller candlesticks, so that's not a bad idea. Now, the be-all, end-all would be this red candlestick right here. This one technically is pretty close to the line of trading on top of the SMA line, but if you want your first clear red candlestick, it would be this bad boy right here. Opened and closed below the red SMA line. That is a clear indication of selling. And you would want to sell, and in this case, it'd be a great indicator because look what happens after. If you sell here at $5.50, you make $60 off the trade. You bought in, actually, we bought in at $3.90. What am I thinking? Wow. So we bought in at $3.90. You're up $4.90 is $100, and you're selling up here at $5.50. So you're making $100 plus. It was another $60 on top of that. So $160 right now selling out of this candlestick. And you're getting out of it before a massive pullback to the downside. And, there's a couple other factors we could look into as to how we knew it was going to fall like that. But the one factor that we knew was it was the first candle that opened and closed and finished below that red SMA line. And if you literally just bought the first green candle that opened above and held above, and then you took the first red candle that opened below and closed below, boom, right there, you sell out. That's $160 profit on 100 shares. It took you about a half an hour, and you also missed out on the massive pullback. Now, whatever happens the rest of the stock, you don't care. You missed out on another run here, yada, 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 it fell back down. You don't care because you're in and out. You're a day trader. You're quick with it. You want to make your profits. You want to make sure that you cut your losses when you need to, and boom. That's all it took, was literally finding that first green candle that opened and held, and we bought in at $3.90, and we wrote it up, and you know what? We missed out because it was up to $5.90 at one point. That's a $200 gain. We missed out on the $200. We let it pull back. We didn't get scared and sell out when it was down to $5 again because we would have lost out on another 20, 30, 40 bucks. We let it run back up because it's still above this red SMA line. And now we took the first red candle that closed below it. And that's a solid trade. Now, you didn't even use any other indicators. That was literally just using our simple moving average line and just taking into consideration what we know about volume, candlesticks opening and closing above the red SMA line, the price, and that's pretty much it. You don't know anything about the news or the catalyst, what's making it run. You don't know how it normally trades. You don't know what the relative strength index is. You don't know what the resistance and support areas are. There's a lot of things you're missing. But just taking into consideration that simple tactic, you were able to make a positive trade on it. And so it's simple methods, I guess you could call it, or simple techniques rather, of trading that, you don't need all the stars to align to make a positive trade. You don't need to go in and make sure that the volume is hot, the RSI is hot, and all these things have to line up. You just made a positive trade, and you made some pretty good profits too. And that was only off of 100 shares. You threw in $390, and you came out with $550. That's a solid win in my books. I mean, off of 100 shares, off of just using one technical, like I said, all we did was bought above the red SMA line, bought and sold below the red SMA line. That's all we did. Now, we can take into consideration different areas of support and resistance. We can do all that fun stuff. But that is pretty much summing up how to trade, at least day trading, simple moving average line off of a cheap stock, a $3, $4, $5 stock. But you can do this same technique with any other stock. We can go over to Amazon here, and we can probably find a similar setup. And it's a little bit different because it's a more expensive name, but we could probably find a similar setup to where we buy the first red candle and then we sell we buy the first green candle and then we sell the first red candle. Now, this went into close. The market had a nice pump in the afternoon today, and I can already tell that this is a beautiful setup. Because look at, you buy the first green candle that opens and holds above this red SMA line. And then we're still on that 9 SMA line on our 1 day, 1 minute chart. So each candlestick represents 1 minute. You buy the first green candle at 233, let's call it 233.60. Right there in the middle, 233.60. You trade, beautiful, 3, 4, 5 green candles in a row. And this distance you see here between the candlesticks and the red SMA line, the larger the distance, the stronger the stock is. Okay? The larger the distance and the gap between, the stronger the stock is. So you're able to say, all right, 233.60, 1, 2, 3, 4, 5 candlesticks. You get a couple candlesticks that don't do a whole lot, created this resistance. And let's just quickly jump into resistance real quick while I got you here. We're going to take this and we're going to drop it here. And you're probably wondering why I dropped this white line right here as a resistance point. Now, resistance is where a stock cannot get above. It tried to get above multiple times this area, which at this line is 234. It tried to break through once, twice, third time, fourth time, fifth time, and it couldn't. So that's a resistance area. Now, after something breaks through resistance, like it did here, it then turns into support because it was so strong and hard to get above that it normally is pretty hard to get below. So resistance point is where stocks can't break above, and support is where stocks have a hard time breaking below. Past resistance is future support. Just remember that. So we're still in this trade because we're still above the red SMA line. We get a massive surge to the upside and it breaks through. And anytime a stock breaks through resistance, it tends to run like crazy. And we saw it here. It jumped from 234, ran through that area, hit a high of 234.47, and then pulled back down a little bit. Now remember, this is Amazon. We're looking at a 1 day, 1 minute time frame. It's not going to move $1 or $2 in one candlestick. It's just not. So you got to keep that in mind. It's a larger cap name. We still have strong volume, and we still have a good gap in between our red SMA line and our candlesticks. And then we have another surge to the upside. All right. And then we hit this top up here. We don't know it's technically the top until we get a massive pullback to the downside. This candlestick would have scared me, but we also have to take into consideration, which I didn't notice before I started this trade, this is the end of the day. This is the last candlestick at close at 4 o'clock. So technically, you would have been stuck in the trade in this scenario, but let's just play it out like it was still trading. Boom, there's your red candlestick, opens and closes below this red SMA line. You trade out there 234.77. You know, it's not about the massive $20-$30 move because we're talking about Amazon, but it's the setup and the idea. You take this idea into a stock that's 10, 15, 20 bucks and it moves $3, $4, $5 and you get a couple hundred shares with that. That's where you make your big money, and that's where day traders tend to trade off of simple moving average lines. Now, this is just one simple moving average line, one technique. Understanding how support and resistance works, understanding how the candlesticks operate, understanding price action, and when you have relative strength index, when you have strong volume, those types of things are very, very important to understand. And hopefully you got something out of this video. Hopefully that you understand at least this is one technique you can use, and there's many, many others, and I'll definitely be breaking down more ideas and techniques and ideologies in future videos. But if you guys enjoyed this video, please, please, please hit that subscribe button, like the video, comment down below what stocks you guys want me to go over in the future, and I'll see you guys in the next video.